Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 11, 2017. Looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Yesterday I said we were going to be on the lookout for a gap and crap, and that would mean that we gap higher at the open and then we fail and fade away, meaning a crap out, and that would mean a potential market reversal, at least in the short term. Well, we got half that story in today. We got the crap, but we got no gap. And I'm still open to the idea that we should hit the ultimate price targets for this particular run up at 240.50 to 241, specifically because today the market had another opportunity to put in a harder sell than it did, and we got an intraday recovery, and we basically finished not near the flat line. The SPDR was down 42 cents or 0.2%, but compared to where we were earlier in the day, certainly a very, very positive sign for the market. We're still in an uptrend. There's nothing wrong with this market. On the daily chart, this is nothing other than a bullish consolidation. However, as discussed last night, because we're really creeping higher, I don't see us building the type of energy that would promote significantly higher prices on this move. We would need to have some kind of a pullback first in order to get much, much higher, namely the $245 to $246 level that I'm looking for on the upside before this total rally is over and the real correction begins in the second half of the year. So with that said, I'm still open to the idea, whether it be tomorrow or Monday, but it's got to happen in the near term. It has to happen, in my book, within the next couple or three trading days to get up to that level. Otherwise, I do think we're going to fail, and we will trade back down slightly and put in some kind of a pullback pattern in order to build energy for higher prices. But I do think the market should hit the 240.50 to 241 level, but it's really got to do it in the near term. And if it doesn't, that's okay. We'll get a buying opportunity on a pullback because this rally isn't over yet. We still have several more weeks to go before what I believe will be the more meaningful corrective phase, which comes in the second half of this year. Nothing turns on a dime. And of course, as we know, specifically at highs in the market, it's like turning an aircraft carrier. It's not easy to turn. It doesn't turn on a dime. A lot of times markets will turn on a dime at the lows, but they don't necessarily always turn on a dime at the highs. They more likely make a rounded top than just an all-out collapse. I'm not expecting any kind of a collapse anytime soon right now. Anyway, that's not the point. The point is I still think that there are higher prices coming. This market showed pretty good resiliency today. Let's go over to the intraday chart, and you can see here we put in a pretty hefty sell in the morning. We put in a doji candle, and off we went. We put in a little consolidation pattern, another consolidation pattern, and the market grinded higher on light volume for the remainder, or the majority, I should say, of the trading day after about the 11 o'clock time frame. And we know much of the time, even if the markets are making a high or a low, the 11 o'clock, 10:30 to 11 o'clock time frame is the time where we usually get lighter volume into the afternoon session, and generally speaking, the market will make a turn around 10:30, 11 o'clock in the morning. That's precisely what we saw today. When we look at the hourly chart, just kind of preparing for tomorrow a little bit, what you see here is we weren't able to get or close above the red candle high, which came in at $239.46. And because that wasn't able, or the market wasn't able to close above that level, we just kind of started going sideways, and potentially tomorrow morning, another hour or two of sideways activity may promote higher prices, or maybe we get the gap and crap tomorrow, or maybe we just get a gap and go, meaning we go higher tomorrow and continue so. Being a Friday, we have less likely opportunity for a sell-off on a Friday than other days during the week. Fridays tend to be lighter volume, and certainly after the morning session is complete around 10:30, 11 o'clock, the market does tend to go to sleep on Friday afternoons. All right, let's go back over to the daily chart. We'll take a look at the IWM, and the IWM was selling pretty good today also. You can see here we came in to test the 50-period moving average, which is the blue trend line, at 237 and a penny. We made a low today of 236.98. Bounced off that level and closed above the 20-period moving average. I think that has some significance. However, when you look at it, we're still in this bearish pattern, okay? So we had a down move, we have a sideways move, and this generally promotes another down move. But like as we discussed last night, and I don't want to rehash everything from last night, but the point is that with divergences in the market and the IWM going one way and the same day the transport's going a different way and the spider's flat, it's unusual behavior for these markets to be diverging, and that's generally a sign of something more to come, whether it be on the upside or the downside. It's generally unusual activity, the market preparing for a larger move. So this IWM still has this bearish pattern intact. I'm watching it very closely, but did show good resilience today nonetheless. Speaking of bearish patterns, when we look at the transports, again, same routine. We saw the bearish pattern that we've been talking about for a few days kind of complete or start to complete to the downside. What we don't want to see is we definitely don't want to see a break of these lows down here. That would promote lower prices, even though we have the 200-period moving average down here. We just don't want to see these lows broken. But the transports were weak today. They're showing signs of weakness. We're below the moving averages pretty comfortably now, and that's not a sign of a positive or bullish market, but yet a sign of a negative or potentially bearish market, at least in the short term. So without the transports and the IWM, it's very unlikely that the spider can rally much from here, or the S&P 500 can rally much from here. And these are, again, discussed last night, but some of the reasons why I don't feel we have enough in the can to really get this market a lot higher from where we are now. But I do have that upside target of 240.50 to 241. I still think we have a pretty fair chance of satisfying that target before any kind of a more meaningful corrective phase begins. So all in all, across the markets, there really wasn't a lot of change from yesterday. We did see a downdraft today, but we did see the recovery, which does show buoyancy in the market. It means there is a bid underneath this market. If there wasn't, and the market, the institutional sellers, if you will, wanted to push the market down, they again had every opportunity to do so today. It didn't happen, and that gives me an indication, or it gives the indication, that there's still a bid underneath this market, and it's just not ready to put any kind of more meaningful sell together just yet. All right, so that's the markets in a nutshell across the board, the stock markets. Let's go over to the gold market. And you can see in the gold market, we are holding this 1221 and change area on the daily chart. Now, we are now putting in a bearish pattern. So if we get a few more days of sideways behavior here, then the likely scenario is we're going to end up trading lower, likely down to the 1200 area. However, if the gold market can close at 1229 or greater, then we'll probably take a run up to that 1242 area discussed, and then if we can clear that, potentially up into the 50-period moving average. What we don't want to see, if we're on the bullish side of gold, we don't want to see the market put in a bearish consolidation pattern, and that would basically look something like this for another few days of sideways activity. Then this would build the case for more downside down to that 1200 area that we talked about. So it's a neutral right now. It's not a bullish. It's not a bearish. We need the market to kind of give us a better indication of what the next larger intention is. And the first thing to do would be to close the day above 1229. If that happens, then that will promote some more upside behavior. If that doesn't happen, then the opposite happens and we'll end up going the other direction, meaning south. And what happens is basically the market tries an area, it reaches, or it'll trade up to a resistance point, and it's basically knocking on the door. And if nobody answers the door or they don't have the key and they can't get in, then it's rejected and the market then tends to trade down in the other direction. And that may be what's happening in the gold market, but we need more evidence. We need a couple of more days to make this determination of which direction it's going to go. Right now, it does not look bullish. It does look bearish. Specifically, the bearish pattern developing, but also the fact that we're below all three moving averages on the daily chart. That's never a sign of a strong market. That's generally a sign of a weak market. And you can see here that the 20-period moving average, which is the red sloping trend line, is sloping downward. As this 20 moves downward, that puts downward pressure on the market. It basically means that the market's not able to put together a rally, which in effect causes the 20-period moving average, specifically in this case, to move downward because gold is not catching a bid. And with that, the bearish pattern developing, the likely scenario is a down move. That's what the odds would favor right now, but the odds are not strong enough to be definitive that we are moving down. We really need to now close below the low from Wednesday to be definitive that we're going lower. But at that point, that's at 1214, and the next downside target would be around 1200. It's not that far away, but that's the gold market in a nutshell. However, was up about $5.50 today nonetheless. Silver had a better day on the upside, but silver has been down so many days in a row, and it's down so much from the last pivot top or the last pivot high up here that it really needs, there's a lot of damage done on the silver chart. It really needs to do a lot of work on the upside in order to get going. And each of these pivots, this pivot here, this is from the 8th of May, and then this pivot, and then this pivot top over here from the 4th, all these will be resistance points for the silver market. Now, if we take a look at the weekly chart, and it's a day early to be doing this or talking about this, but it's worth the conversation anyway, and we'll take a look at it tomorrow night after the week closes. But what you can see here is 3 weeks of downside activity. We talked about that last night. And today, this week, we seem to be potentially, we don't know yet until tomorrow closes, but we're potentially putting in a doji candle. After 3 solid weeks of downside activity, a doji candle short of these lows here would generally be a signal of a reversal, at least in the short term, in silver. So I'm watching it closely. I'll take a look at it again Friday night and we'll discuss it again. But that's what I'm seeing from a longer term perspective on the silver chart. Thought it was worth mentioning tonight, even if not for silver. And it doesn't even matter if anybody wants to trade silver. It's a chart lesson, has nothing necessarily to do with silver. When I show you these things, I'm really just trying to get you exposed to how I look at the charts and why I look at certain things. And all charts are the same as far as I'm concerned. It doesn't matter whether I'm looking at silver or I could be looking at a chart of Apple. It doesn't make any difference. So that's why I show you these things. And I think it's worth mentioning that potentially we could be seeing a low for silver put in this week, at least on a temporary basis. Next up, we'll go over to crude oil. Now, as you can see, yesterday we stalled out at this red candle high. We pulled back a little bit. Today we got above it. We'll see where the official close of the day is. Right now we're above it by a couple of pennies. and we spiked higher. And where did we go? Well, we stalled out right at the next red candle high, which is at 48.23, and today's high was 48.22. You see how that works? The market is like a stair. It's like a staircase. It takes one step at a time, right to the next level, knocks on the door, see if it's open. If it's not, it gets rejected. If it's open, it trades through, and it goes up to the next natural resistance point. And in this case, the next natural resistance point was the previous day's high. So the first one was the large red candle here from the 4th. The high was 47.75. That was what we had to contend with yesterday. And then we move one day backward, and the high was 48.23, and today the high was 48.22. Should come as no surprise if anybody's paying attention to how the market moves one step at a time. That was a natural resistance point for the day. If we can close above that level, then we look to the next resistance point. Same thing goes on the flip side on the way down. This is how the market works under normal conditions. Of course, anything goes. You can get a spike for some unforeseen reason and spike through levels. Of course, that happens quite a bit. But under normal conditions, this is where we find natural resistance points. Which is also the reason why, if you're an intraday trader, that you have to look at multiple charts on multiple different time frames. You can trade off of a 5-minute or a 10-minute chart if you like, but you have to pay attention to the hourly charts for resistance points and daily charts for the resistance points, because those resistance points are much more stronger than any 10-minute chart will ever tell you. So you need to be aware of where those levels are at all times. How about the bond market? We're still hanging around the 150.21 area, which is the 50% retracement that we've been talking about for a few days now. It's not uncommon for the market to find at least interim support at those retracement areas also because of this consolidation here, and it's a natural area that the market would find support. Now, if we consolidate sideways, we know what happens. The likely scenario is we go lower. If we can get a bounce higher off this level, we will need to close above 151.14 in order for this market to get anything going on the upside. Same thing we discussed in gold, same thing we just discussed in crude oil. All charts are the same. They all act and react the same way under normal conditions. We're below the moving averages in the bond market, which is a negative, and will generally promote lower prices. However, if we can get above and close above on a daily chart, above the 50-period moving average, which is the blue sloping trend line, then we'll obviously be less of a negative for bonds and most likely promote higher prices. Right now, we're hovering at the 50% mark. It's a neutral stance, meaning we're not bullish, we're not bearish. We're waiting for the bond market to give us an indication of really which way it wants to go. Net, no change from yesterday. That's the bottom line. And in the dollar, so a little bit of a downtick today. It's just another sideways day, similar to what we did yesterday. We'll see if we stall out here and head back down, or if the dollar wants to trade up to the 50-period moving average and potentially the top of this trend channel. Again, no change in my stance. I still think we're trading down to the lower portion of the trend channel before a meaningful reversal in the dollar. These things take time. That's the way it works. We'll just keep watching it, but no change in my stance on the dollar. And with that, it's everything I wanted to discuss tonight, so we'll leave it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.